Hi there, and thanks for joining us on PhillipCapital's Market Watch. I'm Wee Ming Jie from Phillip Investor Centre, Holland Drive. In this Market Watch, I will discuss about inflation and its outlook in Singapore. It was recently announced that core inflation in Singapore for January 2022 has increased to 2.4% on a year-on-year basis. This is the highest level of core inflation seen in more than 9 years, since September 2012, when it was also reported at 2.4%. Core inflation excludes the cost of private transport and accommodation, as these costs are easily influenced by supply-side policies. Both the Ministry of Trade and Industry, MTI, and the Monetary Authority of Singapore, MAS, Singapore Central Bank, have said that in addition to the slower decline in the price of retail and other goods, the increases in core inflation is largely due to the rising prices of food, electricity, and gas. Headline inflation, which is measured by the Consumer Price Index, remained at 4%. Core inflation had also increased on a year-on-year basis in December 2021 to 2.1% from 1.6% in November. It was one of the highest levels of core inflation reported since 2014. Just a day later, MAS had announced that it would tighten monetary policy by increasing the rate of appreciation of the Singapore dollar nominal effective exchange rate policy band. It was an unexpected move, as MAS usually adjusts monetary policy during their biannual meetings in April and October. The MAS increases the rate of appreciation by steepening the slope of the policy band. By doing so, they will allow the Singapore dollar to strengthen against other currencies quickly. The move will help to make imports coming into Singapore cheaper, which in turn cushion rising prices and mitigate the effect of increasing inflation on the population. Both MAS and MTI have also pointed out that elevated rates of inflation are a global phenomenon, with the United States and Europe experiencing record high levels of inflation in recent times as well. They have said that inflation in Singapore is expected to remain high until the second half of this year, where it is expected to ease gradually. This is due to high commodity prices, such as crude oil prices, which are expected to remain high due to supply chain issues and geopolitical conflicts, such as the current conflict in Ukraine. These high commodity prices will increase the cost of business, and some may choose to pass this increase in costs on to consumers. In Singapore, tighter labour market conditions, especially due to changes to foreign labour policies that were announced in the recent budget, will continue to place upward pressure on wages. This will result in higher prices for services and others. That's all for PhillipCapital Market Watch. Do remember to like and follow us on social media and subscribe to us on YouTube. Leave your comments. Thanks for joining us and see you soon.